Welcome back to another PropertyLimBrothers webinar series. Today, we will be talking about why upgrading from HDB to condo is the new retirement plan for families. So just a quick disclaimer here, all these discussed are just general ideas. So if you want, do meet with a consultant to discuss your timeline, your finances, and also what to buy. Now, in this webinar, what you will learn is why are people upgrading from HDB to condo, and also for those of you that are asking, why would I upgrade when HDB is also appreciating? This is for you. You'll also learn what the difference is between staying status quo, we'll learn from some case studies, versus upgrading, and how to go about your upgrading journey, and how you also can identify the right properties that would appreciate over time. Okay, so for the style of PLB webinars, we adopt a unbiased seller-based lens and also unbiased buyer-based lens. So what this means is when we are representing the seller, we do our best to sell the property to the best of our ability. But when we are representing buyers, we also look at frameworks to discuss what are the best products for the buyer to purchase at that season and time. Okay, we also adopt a no pushing of new launch projects or PLB listings approach where it's unbiased, it's all research-based and sharing on our frameworks.
So for those of you who are not too familiar with PropertyLimBrothers, we are very huge on social media, so you can check out all our platforms. So we have like PropertyLimBrothers, the main page where we have a lot of our home tour videos there. We also have the Insights channel as well as NOTG if you are looking more from an educational point of view. So we are one big realty combined with our media team. All our staff, all our creatives, all of our realtors are all full-time in-house teammates as well. And so I think over the past few years, we have also helped more than 877 families to date with their transactions. And we are also doing a lot of consumer events. In the past few years, we have 3 mega consumer events that have been done as well. And of course, if you want to know a little bit more about ourselves, feel free to check out our website. Our social media statistics are there as well. You can also find some of our Google reviews, some of our FAQs, so on and so forth over there. Yeah, so a very quick introduction to myself. My name is Caline Leong. I'm an associate consultant here with PropertyLimBrothers. So real estate actually is my first job right out of uni. I came into the industry straight. So I think this year is my 8 years in the industry. Pretty much, I love helping families with their portfolio structuring. I love doing things like helping people to upgrade their portfolio, and I truly believe in the no hard selling policy. So sometimes if maybe upgrading is not for you, I will let you know also. So I truly believe in that, and I think that's also why PropertyLimBrothers resonates very well with my values. Yeah. And with that, I'm going to pass the time over to Deborah, who's going to take you through the rest of it.
Thanks, Caline. All right, my name is Deborah. Just a really quick introduction about myself. Prior to joining the real estate industry, I was also a health and fitness coach. And so real estate really combines my passion for health and homes, because before that, I was helping my clients in terms of their physical fitness and health. And now I'm helping my clients to plan out their financial health as well through homes. And also, this caused me to develop a deep sense of fulfillment from helping my clients with their portfolio expansion and also restructuring with customized solutions. So I always believe, even when fitness coaching and even now, start wherever you are at with what you have, looking at the resources that you have. And with that, I also think it's very apt because right here, as you can tell, we've helped our clients in terms of their portfolio planning. And you can see the client reviews that we have. You can also see the home tours that we've done to help HDB upgraders in terms of upgrading their property portfolio. All right, so a lot of HDB owners are now at a crossroads. So once your HDB achieves its minimum occupation period, you'll find yourself right here at this crossroads. And likely, you'll be like 2 different families. So the first family I'll cover is Family A, in which, as you can see here, Family A, they bought a HDB at 450K, and it's a built-to-order. And 5 years later, it has achieved its minimum occupation period, and therefore, now it has appreciated to 750K. So from there, what a lot of families might not do is to plan. Maybe, kids, their career takes precedence at that point in time. And so over the 20-year period, they just hold on to the HDB, and their plan for retirement is just to sell their HDB off. Maybe by the time when they hit 65 years old, the HDB has appreciated, yes, to 850K. And so from the 850K, they would then look at buying a smaller HDB, and with the rest of the remaining proceeds, 300K for example, they will then use for their retirement. So the big question to ask ourselves is this 300K enough for retirement? So we look here, this family that I just talked about, they own a 4 or 5 room flat, and then they plan to keep the HDB all the way. And I mean, good in a sense where there is no stress in terms of low monthly installments, but in terms of how beneficial this in terms of your retirement is something to consider. So compare this and contrast this to family B, where, for example, after the HDB has achieved its minimum occupation period, they proceed to then upgrade and top up their cash for monthly installment to a property that is $1.8 million. So let's have a look here. Once they are after they've upgraded, maybe in the next few years during their retirement phase, they are able to then right-size and cash out, where they then have 800K cash for retirement. So this is just a baseline contrasting both family A and family B. And we are finding that there are increasingly more family Bs. Why is that so? Let's explore. Okay, so first of all, how we know that there's more family Bs is if you look at this chart over here, all the blue colors represent the HDBs, whether it's from 1 room to 5 room flats, and the red color represents your private residential condos. Now, as you can tell, the blue is decreasing over the years, whereas the red is increasing. So you can see that there's been a shift in terms of the demand for more private residential condos. And you can also see here that HDB ownership has dropped below 80% in recent years, and there's also a growing interest in terms of private properties over public housing. Proportion of new private home buyers by age over the years has also decreased. The median age previously in 2015 used to be 45 years old, but now since 2023 it's been hovering at about 39 years old, and we can see that more young buyers under the age of 35 are purchasing private properties. Yeah, and also in terms of the unemployment rate, it is low in Singapore at 2.9%. And what this means with a low unemployment rate is that there has been a generally positive impact on the property market, where people are more willing to buy property prices, and this drives property prices up. And it also indicates strong economic stability and income and growth, which in turn then increases consumers' willingness and ability to purchase private properties. So, family Bs understand a few key principles, and let's go through them. The first is that the Singapore private property, when chosen correctly, is a safe haven with limited supply. So let's look at the cooling measures right here, because over the years, the government has introduced a slew of different cooling measures. If you look at this chart over here, right before 2010, right before 2010, the property market in Singapore was relatively unstable. And this is actually one of the only times that you see the landed pricing marked by the orange line kind of aligned to the private residential marked by the red line, and then HDBs is the blue line. So all of these are relatively aligned before the 2007 era. Now, what happened in 2008 and 2009 was the US subprime mortgage crisis, and this caused the property market to slump. But after 2010, we saw the property market slowly recover. But there was an event in 2013 that caused property prices to plateau and even decrease or depreciate over the years, and that was actually the slew of different cooling measures here that the government introduced. So some of them are like your loan to value, or if not your ABSD as well. All these were introduced to stabilize the property market, and because of that, this helped the property market to stabilize. And over time, you started to see that in 2020, there was already a divide in the landed property market compared to the private property segment for condos. And HDBs is the blue line. So you slowly started to see that, yes, from 2020, during COVID, all the properties started to appreciate, but there's already been a divide in the landed condo and then HDB segment. And also the effect of TDSR. Currently, if our TDSR is at 55%, can you imagine the impact if, let's say, our TDSR were to be adjusted on property affordability? So we want to understand the mode of Singapore property prices. And if we have a look here, just a very brief overview is that we have external factors that influence our property market, but we also have internal factors such as strong government, our cooling measures, etc., that will help our property prices to appreciate over time. So the base support level for the Singapore property market and our mode is that as a start for HDB, it is grants and subsidized new flats. They are introduced for people to just start out in the property market. We also have a sound government, we have the URA master plan and all the cooling measures that I just talked about. And there's also a high ownership rate in Singapore. And people are just starting out, maybe they just buy a BTO and they have their resale grants built in, and over time there's this paper gain. And if they then proceed to upgrade to a condo and finally, slowly they make their way towards the landed market, right? So this is essentially the entire base support level of the Singapore property market. Now, in terms of supply of private residential units in the pipeline, they are pretty limited. So you can see that in 2024, now this is at one of the lowest and planning approvals. So all the properties that are planning approvals, one of the lowest. And this chart itself shows the properties that are under construction at this point in time for private residential units, also quite low. And if we take a look at the total breakdown of properties in terms of HDBs, condos, and landed, you notice that HDBs form a huge majority of the percentage. So if you see HDBs are at 74% or 1.2 mil units available. For the private non-landed, you have about 320,000 units, and this excludes your ECs. And finally, for landed, is the most limited in supply, 4% of the entire property market, and that is 73,000 units. So as you can see here, if let's say you break down the private condos, right, the circulating supply is actually only 260,000, whereas this 68,000, which is owned by PRs and foreigners, are usually not very liquid in that sense, because ever since the government introduced ABSD for foreigners, right? So you have 60% ABSD, or even for PRs, 5%. Then usually they prefer to hold on to these types of properties, continue renting it out, because if they were to sell their properties, then what this means is that they would then have to purchase another property if they want to, and incur that ABSD. So they rather continue getting rental yield from it. And we can also see that the next transformation of Singapore, 2020 and beyond, so looking towards 2030, is that we are looking at a 6.9 mil population. And over time, as we can see, 50% will be Singaporeans and 50% will be foreigners. So let's look at, in 2030, who is allowed to buy what types of properties. Actually, the majority will be allowed to buy condos. So these are the types of properties that even foreigners or even PRs are able to buy, whereas for HDBs and for landed, only Singaporeans are eligible to buy. Yeah, so same thing right here, condos, they can buy, so all, whether it's Singaporeans, PRs, foreigners can buy condos, can buy shophouses, and Sentosa Cove landed. So let's look at the price elasticity to supply, because if let's say for HDB we have the most abundant condos and then followed by landed, then in terms of the hardness of asset, HDB is the softest. And what do I mean by that? So in terms of landed, it's the hardest residential asset because even when I try to increase my price, let's say landed buyers are willing to pay a higher price, but there's only so much supply within the landed market. Which means, just now I mentioned there are 73,000 landed homes. The only way that we can increase the landed supply in Singapore is if we subdivide a huge plot of land into two, for example, and then we have now 2 units. But otherwise, Singapore is relatively land scarce, and therefore, landed is a very hard asset. So as we look over here at how different property types have appreciated over 9 years, we see that HDB has done fairly well in terms of the appreciation, but look at condos and also look at landed, and you realize that in terms of the percentage increase over the years, and even in terms of the quantum, it's really a huge disparity as compared to the HDBs. So, supply of non-landed private residential properties, currently every year, we are increasing at a rate of about 10,000 units. Whereas for landed, as I mentioned, it's very hard for supply to increase, and therefore it has been stagnant or plateaued since 2018. Now, for HDBs, the government always strives for HDBs to be the most affordable for Singaporeans. And therefore, whenever HDB prices rise too high, what the government does is to start increasing the supply, building more of HDBs and ensuring that construction is quick enough so that they are able to produce more supply, right? So there are also tighter restrictions for the new class of BTO flats to prevent a lottery effect. Yeah, so essentially, elastic assets will attract more regulations to curb demand and supply increases. So the government will start to introduce a greater supply of HDBs, whereas for condos, they would invite less restrictions as compared to HDBs. Right, so look here at HDBs. When the government introduced the standard Plus and Prime, now Plus and Prime has more regulations. For example, even after the 10-year minimum occupation period has been fulfilled, there is still a wait-out period if resale buyers are private owners, and also in terms of being able to rent out your entire flat, there are limitations to that as well. So again, just to recap the soft and hard asset, HDB is the softest asset and then landed is the hardest asset. But if you're in a position and you're in the right season to invest, then always switch to the harder asset. For example, from HDB, then you can switch to a condo, which attracts less restrictions or regulations. Okay, let's look at principle number 2, which is loan capabilities during income-producing years should be maximized. So we all go through this cycle where we have active income, whether it be that you are self-employed, or perhaps you run your own business, or you have a full-time job, right? You strive to convert your active income to asset income, such as property, such as your stocks, your dividends, and also you then, in the end, convert this to passive income for your retirement. And if you look at when our active years are, it's actually during the ages of 25 to 55 typically. So this is actually a very crucial period for you to move your active income to asset income. So let's look at a real-life family B case study, Daniel and family. So it's actually been a property journey with them for 13 years and counting. And so we look at Daniel and family. They started off with a 5-room Pongo HDB, which they eventually sold for 600K. And when they did sell that, they then kind of decoupled, right? So Daniel and his wife decoupled, and then they bought a 1.6 mil penthouse under one name and a 1 mil rental investment in 2015. Now, 5 years later in 2020, the 1.6 mil penthouse had appreciated. So they managed to sell it off, and then they moved on to a landed property for the family to stay. And the 1 mil rental investment had also appreciated, and so that's where they continued holding on to that property. And then now, just last year in 2024, the landed property had already increased in its valuation to 5.8 mil, where they continue to stay, and the rental investment had also appreciated to 1.5 mil. So the most recent development for Daniel and family is that we've actually sold off their rental investment, and they've also just purchased a new rental investment at Parktown Residence. And so now their total portfolio is an impressive $6.5 million. So what can he do with this $6.5 million? And so that will be actually when he's 65 years if we are looking at long term. So at 65 years of age, what can Daniel do? So he can potentially look at a passive income of $2 million at 5% dividend stock. So then he gets a passive income of $8,300. He can put aside $500K in terms of cash for just his liquid freedom. And then he can look at a $2 million HDB or condo up to him for just own stay. And finally, the passive income, he can buy a $2 million rental property and then have a passive income of $5,000 a month. So this is how he might divide his 6.5 mil over the next, when he hits 65 years old. And this is how he then plans for his retirement. Alternatively, if he doesn't want to wait till he's 65 years old, when he is 55 years old in the year 2040, not too far from now actually, right, in the next 15 years, he's also able to look at this kind of split where there's a passive income, 1 mil at 5% dividend stocks, he has a liquid freedom of 162K, he buys his own stay condo at 2 mil and also has a passive income from a 1.5 mil rental property. So what this gives him is two things. One is the freedom of choice of what he wants to do, given that he has over the years increased his net asset value. And number two is the legacy planning, because he can choose to then pass down his properties to future generations. Contrast this to family A again. If family A were to, maybe at the age of 55, think, maybe I want to start restructuring, my portfolio. I want to look at my active income and how I can buy a next property. Now, unfortunately, because of their age, the loan tenure will be limited. So look at this, 35 years old, I'll be able to loan, assuming they can both loan the same amount. So 35 years old, 55 years old, I'm looking to loan 1.35 mil. Okay, the monthly repayment for the 35-year-old will be $5,000 odd, whereas the monthly repayment for the 55-year-old will be $12,000 over dollars. And why this is so is because the loan tenure is the difference, right? 35 years old, you can still have a loan tenure of 30 years, whereas 55 years old, you only have a loan tenure of 10 years. So what this means, lower loan tenure means a higher monthly installment, and therefore you have poorer cash flow. So even if you can loan the same amount at 55 as you are 35, this is something that will be of consideration. So in the end, even if you want to upgrade, maybe you can't at that point in time when you are 55 to 85. So if your asset value is weak, then your freedom will be limited and you'll only be left with $300K for retirement. So principle number 3, family Bs know which season of property investing they are in, because there are 4 seasons. Spring, where you're usually 25 to 35 years old, you want to be a bit more aggressive here because you're able to loan for a longer loan tenure and your monthly cash flow will be a bit better. Summer is usually 35 to 45. You are still aggressive because your income is growing as you progress in your company. And then your life commitments here are stacking up, but you still are able to afford it because you have your active income. Now, in autumn, you are usually 45 to 55 years old. Now, this is almost the last stage of your growth already, where you're kind of mid-aggressive, okay, and you have a lot of life commitments here. Your kids are older. And winter is then when you become a bit more defensive. So if you look over here, growth happens from 25 to 55 years old. And then, of course, you start looking at consolidating your assets after that, and then you decumulate at the end. And you also think about legacy planning. So it's very important that during your active years, when you have an active income, that you are thinking about doubling your property portfolio. So if you look here, how this cycle works is that perhaps as a single, you purchase property, right? So in this case, maybe for example, you're a HDB upgrader, and now you're able to upgrade your property. You are able to move your funds, your down payment from the cash proceeds that you've earned into, for example, a 2 mil property, and then let it grow, okay, before you then recycle the funds over for the next cycle. So some people might ask this question, Deborah, then won't my monthly mortgage be higher? And you are actually right? Because as, of course, your loan increases, your monthly mortgage will increase. But let's first understand the real breakdown of your monthly mortgage, which is your principal and your interest. So we take a look here. We have a monthly mortgage right here of $337,500. Okay, and if let's say you break it down over 25 years, then your monthly repayment is $1,500 odd. But the real breakdown in terms of principal and interest is this. Interest is about $700. Principal is about $800. Okay, so if we look here, the interest incurred for a 450K property is actually, a percentage is 1.85%, okay, of the property value. Okay, now we look at a higher quantum, and we look at a 1.8 mil property. In terms of the same loan tenure, 25 years, your loan amount is 1.35 mil. So monthly repayment now has increased to $6,000, but the breakdown is in terms of $2,800 interest and $3,200 principal. And still, the percentage of the total property value is 1.85%. And now let's go a little further in terms of a 5 mil purchase price. Let's say you're looking to buy a landed, then your loan amount will be 3.75 mil. Monthly repayment will be about 16 mil. And your breakdown of interest will be 7,800, principal will be 9,000. Still, a 1.85% estimated on the 5 million property valuation. So in terms of all the interest, actually, if you look here, they're all 1.85% estimated, and therefore your monthly installment then becomes a form of forced savings for you. As you age, so from age 35, you sell your HDB and you upgrade, and then you double your property portfolio over time. This will allow you to eventually have an asset value, in this case of 5.75 mil. Now, in the year 2045, let's say you have this asset of 5.75 mil, you are then able to break it down like Daniel and family that I shared earlier, and this could be a potential way you do so. So then another question that I typically get is, then how about I just keep my HDB and then I just invest in stocks or REITs? Now, it's not wrong to invest in stocks or REITs, and in fact, that could be another form of diversification. But let's take a look here at the fundamental differences between property and also dividend stocks or REITs, okay? So property-wise, you have a 3 times inflation factor. Later, we'll talk about inflation. You also have the utility value as well, because you get to stay in your property or you can rent it out to generate income. You yourself own the title, and you also have a good debt leverage because you're able to loan 75%. So you just have to down pay 25%. Now, for dividend stocks or REITs, there's no utility value. You just hold it, right? And the dividend payout is kind of similar to your rental play in the property market. It depends on the performance. So it's, yeah, you're really depending on the management team, and leverage-wise is risky. So if you look at property itself, how leveraging works. Let's say you down pay 500K, and then your loan is 75%, so it will be 1.5 mil. In 3 years' time, if it does appreciate to, say, a 20% increment, now that 400K, the bank is not going to come to you and say, hey, Deborah, now that you earn 400K, we need to split the profits and divide it. No, this 400K earnings will then belong to you. If you look here, the banks do not expect that they have to share in your profits. So some people might also ask, okay, let's say I keep a HDB and then I invest in the dividend stocks. You could do so, right? So let's just play out 2 different scenarios here. One is that the person keeps the HDB after it MOPs, and then there is 28 years of consistent investing in 4% dividend stock. At the end, they will achieve 1.3 mil plus 400K retirement fund. So in terms of, this is also technically 1.7 mil, right? At the bottom here, instead of staying or holding on to the HDB that has achieved its minimum occupation period, you switch to a private property of 1.5 mil, okay, and then you continue to expand your portfolio. At the end, you also have a 1.7 mil retirement fund. So what is the difference? The difference here is that your family gets to enjoy staying in the private property, right? You get to enjoy the facilities, and not only that, I'm also not even considering that you might do the doubling of your portfolio strategy here. And this is also assuming that if you were to invest in your 4% dividend stock, that you are very consistent in doing so. Because some people, when the market goes up or when the market goes down, they get very fearful. And so do you trust yourself enough to be consistent and stick to your strategy of consistently putting in 4% month on month, year on year. Okay, so this is something to consider. And you and your family also get to stay in the property itself. Okay, finally, principle number 4 is property is a great hedge against inflation. So just now I talked about the difference between a property and also owning stocks and REITs. Now, property is 3 times inflation factor. And why I say this is because if you look here at the CPI, in 2024, it was 2.8%. So we have to ask ourselves this question: do property prices appreciate the same as CPI? And we look here in the OCR Pongo, for example, over the past 4 years, there's been a 6 to 7% per annum increment, and total of 27% increase. Then we look here in Sembawang as well, 37% increase. And in the RCR, Balestier and Toa Payoh, there's been a 34% increase in the past 3 years, 11% per annum. RCR, Balestier again, 32% increase. And so if we compare CPI inflation, 2.8%, versus property appreciation at about 7 to 8% per annum, it's about triple the inflation factor. So again, we look at a real life family B, and this was a family that approached us in 2023. Right here, so essentially when they bought their property in Chai Chee, it was at 400K. And eventually when we managed to help them sell it, we sold it at 739K right over here. But what we did with that is that we managed to help them to upgrade their portfolio. So they topped up the cash for monthly installment and they upgraded to a condo at Waterbank in Dakota. So at that point in time, they paid 2.145 mil for this property. And in Waterbank at Dakota, you get the advantage of schools, good schools around the area. You also kind of move towards the city fringe. And with that, just in a span of 1.5 years as of January this year, they've already seen a paper gain of 405K. What if they had continued to stay at Chai Chee? So let's see how the performance is at now. So recent transactions at Chai Chee are at about 740K to about 800 odd K. So if they had stayed in the same place, they would have made 1K to 61K over the last 1.5 years. And what is their opportunity cost of not upgrading? It's actually 344K of missed opportunity. So now I'm going to pass the time over back to Caline to cover the rest of this webinar.
So I think just to add on the case study that Deborah was sharing on how families from their HDB have upgraded, let's take a look a little bit more on some of these case studies that we have successfully helped our clients with over the past few years. So this is the Gunn family, let's call them Mr. and Mrs. Gunn. We sold off their 5-room HDB at Canberra Crescent just in year 2022. So back in year 2022, you can see that we sold it off at 710K. We then brought them to buy a 5-bedder back in the Sembawang area for their family needs. So this is at Sky Park Residences. And in fact, when they bought at $1.81 million back in 2022, it was a record high price. However, I think after we take a look at the numbers, we take a look at all the surroundings, we felt that there was still great value, great potential in this project. And that's also why we told our buyers, you know what, go ahead. We still think it's a good buy. Let's see how the performance is like in the recent years. So same thing, if we take a look, if they had continued to hold on to their HDB, they would still have seen a very healthy gain of like over 90K just in the past few years. However, because they have decided to park their funds into a stronger asset, and of course that's also through like the right selection of properties, through the right selection of unit as well. Right now, they are already sitting on a paper gain of more than 290K for this particular unit itself. So I think if we put them all together, this is what it actually looks like. So if they had continued to stay put in their HDB, not to say that they will not earn, they will still have earned 90K, but because they have decided to pump themselves into a harder asset, right now they are sitting on a higher paper gain of 290K, so that means an additional 200K just by switching to a stronger asset class. And of course, this is also through the concept of like forced savings, when you sort of use your monthly installment to help finance as well. Similarly, if we take a look at another case study, so this is Mr. and Mrs. Neo family. They own a really nice HDB. This is Skyview at Dawson, great location. And I think if we all know in the past few years, central HDBs have been doing very, very crazy prices. So if we take a look, back in 2021, we helped them buy an OCR project. So we went on to buy a 3-bedroom for their family needs also. Bought it at 1.32M for a 1195 square feet 3-bedroom. And then in terms of 2021, we actually sold their HDB off at 865K. And I told you, how crazy prices were in the central area in the past few years. If you take a look, if they actually held on to their HDB, they would have made a lot also. They would actually make 235K gains in the past 3.5 years if they have held on to their HDB. However, if we take a look at the private segment, because of the right selection, the right kind of unit types as well, and also because of the way the supply and demand works in Singapore, this particular project here at the Quartz has done pretty well as well. In the past 3.5 years, they have sit on 491K in terms of a paper gain. So similarly, if we put them together, you can see that by switching up to a harder assets, our clients are able to enjoy an additional 256K just by pumping themselves into a stronger asset class. Okay, so you might be thinking like, hey, all these are like really, really good examples, but how about those times in the bad market? So when was the bad market? If we take a look at the Singapore chart, let's rewind back the clock to 2013, because 2013 was when the market sort of introduced a lot of cooling measures, and that's also when you see in 2013, the prices then start to dip for property prices, right? So let's rewind the clock back to then, and then let's take a 10-year horizon to see how the properties have performed between like the HDB asset class as well as the condo asset class. Alright, so if back in 2013, if you remember, or maybe you were hunting for a house then, you could actually get something that was newly MOP in the Sengkang region. So this is at Fernview, 4360. You could buy like a 4-room in that area, or maybe in 2013, if you've been deciding whether to go for a condo, you probably could have seen like maybe like the Rivervale, something that's pretty close to Buangkok MRT still, or maybe you were also considering other projects in the area. So let's take a look at the Rivervale first. So in 2013, Rivervale 3-bedroom, you are probably looking under 1 million in terms of an entry price. So you can see the transactions were like 988K. Fast forward to 2017, if you remember the chart, it took a dip. Right, so in the dip, the prices really did drop. So this prices dropped to like 885K, 860K, 900K. So the property market actually took a hit. If you had held on, you had sold in 2017, you would have made a loss. So however, if we fast forward to like a 10-year period, because after that the market rebounded up, the market went through the correction period as well. Right now, if they had held on to 2023, it actually has profited. They would have seen a 300K profit for this particular case. So similarly, let's take a look at another example here at Nuavo. So Nuavo is pretty near Yio Chu Kang MRT. If you have bought in like 2013, 2014, you have bought like 965K, maybe slightly above the $1 million mark as well. Fast forward to after 2017, 2019, if you have sold it off, the prices were the same, or in fact, you will have lost a little bit of money because the transactions were like 1.02, 1.058 as well, for exactly the same size of units. And right now, if we fast forward back to 2023, after the market has corrected as well, after holding on for like 10 years, they actually have seen a profit right now of 100K to 300K profit. Of course, it might not seem a lot, but I think importantly, what we want to see is how the HDB has then performed in this 10-year period as well. Okay, so a little bit confusing here, just focus with me on the 4-room flats first. So if the 4-room flats here, based on time period in 2013, they were going for about 523K, 525K, so let's take it about 520 odd K. Fast forward back, if we compare to the same period in like 2017 odd, you can see that for the 4-room flats, they are doing like 425K, 425K, 418K, so it really took a dip as well. So the entire property market was affected together. Coming back to 2023, so 2023 in the same time period, it has rebounded to probably 550K, but in terms of the growth acceleration between like the year 2013 to year 2023, it was probably either stagnant because it's just like a 10, 20K sort of growth, or you just probably see that little gradual growth itself. So I think what this means for you as a homeowner is that if you have done the right selection of maybe a private property, your money can actually be parked into the harder asset, because this means that the rebound for the private market would be more positive, right, as compared to the HD market space, and also acts as a safe haven to protect your funds, especially in the downturn market. But of course, all this comes with like great understanding of the market as well, and having like really good holding power, because sometimes if we have over leverage in certain scenarios, then maybe at certain bad economic crisis, we would still have to let go at a negative sale. So I think it's really important to sort of plan your horizon in that sense also, in terms of upgrading your journey. All right, so then you might be asking, hey, how can I go about upgrading my entire portfolio, and what's my upgrading journey? So I think naturally everyone wants this, right? Everyone wants to upgrade into something that's going to make money, something that's going to continue to enjoy an uptrend effect. So we want projects like that. So for example, if you take a look at this profitability chart, or rather the transactions history, it's always on an uptrend manner. We want to see a lot of profitable transactions. We want to see like high annualized gain. We don't want to see any much unprofitable transactions. So similarly, another project here at Mera Prime, same sort of performance, high profitable transactions, nice curve going up. And I think what's important to note that all these projects here, they are already like what, from like 99 years from 2003, completed back in 2006. This means that there's already been change of hands. Whether you are a new launch owner, whether you own it from day one, whether you came in like maybe 5 years later, you bought it as a resale market, you would still have seen a positive growth, you would still be able to profit. So this means that it doesn't mean that you just buy new launch, you confirm make money. Maybe if you buy resale, you don't make as much, right? If the right selection of property can be done, or whether you're a new launch owner or whether you're a resale owner, you can see that kind of positive gains as well. So similarly, something that's a little bit newer, this is Park Colonial. It did pretty well in terms of its performance as well. And of course, I think just like what I mentioned just now, all homeowners, whether we are entering into a new launch, resale, sub-sale, we always have a fair chance of still profiting from the property as long as the selection is right. So of course, not all private properties make money. In fact, I believe maybe if you talk to some of your friends, maybe some of your parents, the older generation, they might tell you like, hey, you know, property investing very risky, can lose money one. Why do they say that? Because all these are true. But let's take a look at these examples here. So all these projects that I'm going to show you, their performance, they are located within 5 to 7 minutes walk from an MRT station. A little bit of a lag time here. Some of these projects are even freehold. They're even like walking distance to MRT as well. And they're all like big scale projects. But let's take a look at their price charts. So take a look at this. This is actually what I call like a downturn effect. It went up a little bit and then it came back down. So this means that the performance didn't do very well. You bought it as first owner from 2015 all the way here to 2024, you probably have seen a negative sale. Similarly, these are charts showing negative sales, this in like District 1, District 2, so really nice areas, central areas, high volume transactions, 510 units, 99 years, pretty new, but we still see price charts like that. So Sentosa Cove also, there are certain projects that didn't do very well. D7, 360 units, so nice, healthy volume transactions. However, in terms of a pricing transaction, it's not doing as well. Freehold, 338 units in central D9. This is also sort of the downturn trend that we have seen. D11, D21. So all this kind of performance is not restricted to just like a particular central region, or it doesn't particularly mean that only like a certain district have this kind of performances. You can see that all these performances can really vary throughout the entire Singapore, different kind of districts. So I think like within each district itself, we also have to be very mindful. So we also want to understand, you know, hey, does it mean that all new launches make money? So I think a lot of times we have here the hype of, you know, buy new launch, because if you're the first one to buy, no one else make profit before you'll be the first to make profit. Now let's take a look at all these examples. So of course, if you have done a good selection of a new launch, this is potentially what you can be enjoying as well. Nice profitable transactions, uptrend movement as well. So these are just like 3 or 4 examples that we've seen in the past few years. Or it could also look something like that. So this is really a new launch. However, it has seen a downturn effect. So unprofitable transactions were seen. So this is another example as well. And in fact, I think this project did really well. It sold out 70% on their launch weekend. However, let's take a look at how it's performing right now in today's market. So you can see that it went up. Developer continued to increase the price. A lot of people like it. They continue to buy. However, downturn back now in year 2025. Total of profitable transactions remains at 16. There is actually 0 unprofitable transactions. So it shows me like a little bit healthy, right? There's no one losing money here. However, what we really want to understand what's happening on the ground is that if you take a look at the number of supply, number of listings for sale, we have 197 listings for sale in this particular project. However, in terms of the transactions just now that we've seen, they are all only at 16. So that also shows me that the demand for this particular project in today's market is not strong enough to meet the number of supply. And therefore, most of the times, what you can compete on if you are looking to exit as a home seller, it would likely be the price, right? Of course, unless you have like really strong marketing or you are able to have something that's a little bit different in your house that stands out from the rest. If not, most of the time, you're just competing based on price. And in fact, most of the owners, in terms of like the listing prices right now and versus what they have bought in back in like 2020 are actually at the same price. So that also means that after factoring all their like buyer's stamp duty, their additional costings, they were probably seeing a little bit of a negative sale as well. Alright, so then we also want to ask ourselves, does it mean that, okay, you know what, let's just buy something that with very high rental yield so I can cover my money installment, very safe, I don't need to top up cash. Buy something that is near MRT, maybe integrated in fact, so that I have really nice rental yield. Would that be the best investment? Let's take a look at this real life case study. So this client came to us for a consult as well. She figured that she had a really nice portfolio, but she wanted to see what was the missing piece inside this particular portfolio. So let's call them Family X. So for Family X, they actually have 4 properties, right? So it sounds really beautiful. They are all rented out, all passive income, and in fact, one key point is that they are all fully paid. There is no loan taken on for this particular properties as well. Right, so pretty much no stress, they're just collecting passive income every month. So is this not very powerful? But let's take a look at the entire portfolio in totality. So in terms of the pricing appreciation, because they have bought something that's of a smaller size property, in terms of a supply or rather an asset class, this would be what we term as the low growth sort of properties. They might give you really good rental yield, but in terms of a growth or capital appreciation, it's on the slower end. So for example, let's say she bought initially in like 930K, however the current sort of transactions, kind of bank valuations are still doing just around the 1.02 mark. Still will have seen some level of gains, but I think in terms of the growth rate, it's just not fast enough. Even after I factor in all her rental that she has collected, all the rental yield that she has earned over the years, effectively what we are looking at on an estimated total growth, even with the rental, is actually just around the 2% mark per year. So if let's say we are looking for a portfolio, something like that, it might sound very nice, very powerful. We have 4 properties, all rented out. However, if the real is just at 2%, I would think that actually it would be better that you park your funds into CPF, because CPF is going to give you easily 2.5%. If you're done like maybe stocks, equities, crypto, something else that's a little bit more fruitful, you could have actually make that kind of money work even harder for you. So that also means that, you know, if we do not deploy the right strategy, it might be better not investing in the property market, right? You might be better off putting your money somewhere else that's going to work harder for you. So even when it comes back down to property investing, if we are talking about a retirement planning, it really boils down to right selection, right strategies. It's not just like buying the cheapest sort of condo you can find or buying the nearest to MRT property that you can find. There's really a lot more thought process going into it and a lot more analysis as well. And let's complete this case study with this scenario as well. If, you know, assuming back in year 2020, anyone with a budget of, let's say, under $1 million, they were looking for something in the Pongo region, for example, they could have actually gone for Watertown 2-bedroom integrated development. Very beautiful. You have like a lot of facilities, a lot of amenities right downstairs. They could have bought a 2-bedder, 807 square feet for, let's say, 988K. Fast forward to today, they will have still seen very nice gains. They have profited about 462K in today's context, 2025. However, at that same price, right, back in 2020, they could have actually gone for something that's much further from MRT. This project here is at Riviera. It's closer towards Riviera MRT. It's LRT, sorry, Riviera LRT itself. They could have bought a 3-bedder here around the 980K range, but of course, no doubt, lesser amenities, no MRT within the area as well. However, if we fast forward to today, the profits that they have sit on is 585K. So that also shows me that, you know, hey, just because I buy MRT doesn't mean that I will profit more than those projects that are away from MRT. By switching to something that's not near the MRT because of the right selection and the right frameworks in place, they would have been able to make an additional 123K just by going away from the MRT as well. So this also shows us that it doesn't mean that not near MRT, not integrated, same entry price, it can still perform better. It's really just down to like all the kind of selection tools as well as frameworks that we use. So I think coming back to recap very quickly, if we are not able to find the right property, we are not able to deploy the right strategy as well, then sometimes property investing might not be for us, because I think we really want to have a good understanding of the market first before we park all this hard-earned money, you know, all this active income that we've accumulated over the years into something that does not really reward us at the end. And I think for this little question here, so you might be saying like, hey, I have fully paid with my CPF. Am I not debt-free right now? Okay, so this one, I would say, you know, keep an open mind. It can go both ways. It really depends on how you are planning your own personal sort of finances and what's more comfortable for you. 100% there's no wrong with using full CPF for your housing. In fact, I think that the CPF Housing Board has done it very well in the sense that it helps a lot of young families kickstart their home ownership journey. But something to take note is that if you have held your HDB for the full 25 years, for example, right, and if you use full CPF to pay right from the start, you fully paid 500K. 25 years later, because the CPF OA will have actually earned you about an interest rate of 2.5%, you will now need to top up 926K at the end to go back to your CPF OA because you use this money from CPF OA to finance the property. So this doesn't matter whether you're buying a HDB or whether you're buying a condo. Just something to take note is that if you're using CPF very actively, we always want to plan in terms of an exit strategy also, like how long should you be holding this property, maybe when's a good time to sell as well, because what we want the least is that, let's say at the end of 25 years, now you want to downgrade to a 2-room flat. You realize that actually when you sell, you either have to sell really high, like above this kind of amount, or you're going to look at a negative sale. There will be zero cash proceeds. You will still get back like your CPF usage. Or sometimes if, let's say, the market changes, regulation changes, you may even need to top up back that kind of shortfall back into your CPF OA account. Right? So I think that's something just for food for thought, something that people should also reconsider when they're sort of financing their down payment or their monthly installment. So of course, lease decay is always a concern for HDB or whether it's a 99 years project. So coming back to the question, I think it's really important to plan your exit strategy. Sometimes when we have bought something that is very young right now, we also want to think about, hey, how long am I going to hold this period for? Right? Am I going to hold this property for 5 years, 10 years? Can I visualize myself 5 years later, 10 years later, how old is my current property going to be? Will it be too old that nobody wants to buy into? So I think sometimes it is very important to do a little bit more of a forward planning rather than just, like, hey, I'm so comfortable here, let's just see how it goes. Right? So if you want to make your money work harder for you, especially in the property sector, it's important to plan ahead. But then once again, housing is very subjective. If it's really purely for utility value, purely for your housing or your family needs, then there is no right or wrong in this scenario. You do whatever is best for your own family needs as well. In terms of a property investment standpoint, there are also other sorts of investments that we can do if we are not doing property investment, right? We can put our funds into stocks, into ETFs, into REITs, mutual funds, bonds, crypto, so on and so forth. So I think when we come back to talking about investment, so investment is really very much big basket of everything. You probably want to have a little bit of everything, but I think if you're looking particularly into the property segment, then it's key to have a good understanding of it as well. And I hope that today's session, through what Deborah has shared as well as what we have shared, that you have gotten a better understanding as to why property has been a very safe haven for a lot of investors to park their money into this kind of stronger assets as well. All right, so just a little quote that I took online. So retirement is a journey, not a destination. So I think we need to be very well prepared for the ride. So in that sense, what I'm saying also is that I think we really need to be forward planning, is what we have covered just now. So intentional planning through the right selection of property is going to really help propel your entire retirement journey as well, so that we can look something like Daniel and family. We can have that kind of strong asset class at the end, so that we have a little bit more freedom of choice and we can also enjoy that kind of legacy planning. Coming back, so this was Daniel's family's sort of portfolio, if you remember. We want to have that freedom of choice as to when we can retire. Of course, we also want to have that freedom of choice as to how we want to park our money, how we want to park our funds at the end of our retirement stage. Okay, so when I talk about intentional planning, I also want you guys to think about what is your strategy, right? Do you want to sell your current HDB? Maybe buy the next property under one name if your manner of holding allows you to do so. Do you want to sell one, buy two? Do you want to buy two properties, husband, wife own one each? Or do you want to sell your HDB, maybe buy one big condo for your own stay, family needs, just owning one together would be fine. Or maybe even sometimes going down to a smaller asset class and then using the rest of the funds to do other sort of investment, not property related. You can be doing like crypto, you can bring stocks, ETFs, so on. So these are investment options that we have available. Right, so I think all these are things that we can think about also. So sometimes you might be asking like, hey, do I just focus on rental yield, focus on MRP only, or should I just focus on the cheapest entry price, right? So I think we have covered all this quite a fair bit in the examples we have shown above also, and I hope that has answered your questions. And I think it's really important in terms of intentional planning to understand all this. Holding period, right? That's really important. If today I'm 35, 10 years later I'm going to be 45, 20 years later I'm going to be 55. So in each milestone, what do I want to achieve for my own family? What kind of portfolio do I want to have? Right? I know sometimes it's a bit of a scary topic to sort of think so far ahead, but it's always good to have this kind of discussion with your family. So I think that's going to take you guys through the direction and then have a little bit more prep time, as well as, sort of like a direction to move forward with also. We also always want to understand and have very clear understanding the number of names we have. I have one name, my husband has one name. How many names do we have to buy properties? What our finances look like? Who should be buying what kind of property, who should buy the bigger asset class, who should buy the smaller asset class, who's getting older first, who is going to be able to exit faster first. So all these are things to think about as well. Cash flow in terms of your money installment, coupled together with the fact that your family needs to be addressed. So of course, we can go to something of a higher commitment level, but not affecting your family lifestyle as well. Right? Of course, importantly is to always understand the angle that we want to have in mind as well. So how do you then select the right property? So I think this question, the true answer is this. It really boils down to all the frameworks that you use in terms of making that kind of sound decision as well. So here at PropertyLimBrothers, we have many different frameworks that we deploy for all our clients, especially when they come on board with us for the buying side. But in terms of an investment analysis, there's really just two key main points that we want to touch on. One, the property that we select must have a capital appreciation level. Secondly, we must have an ease of exit. So these are the two must-have in terms of a property selection. Right? So rental not so important. What we want to see is always capital appreciation more than rental yield, because this is going to beget a lot more gains compared to rental yield. Ease of exit, you might think it's not important. However, it's really important. Because if, let's say, it's a bad market, or even if it's a good market, or if it's a very competitive market, you want to have that option to be able to exit when you want to, right? You don't want to be only able to sell a property just because right now the market has gone up on an upturn, then there's little supply, then you can sell. Because sometimes maybe, hey, you really need to move for your family needs already. However, because of the wrong selection of a property, the property has not enough demand, you're not able to exit within a certain time frame. So I think in terms of ease of exit is something that we also want to be very mindful of. So these are some of the frameworks that we use. So we also have this thing called the mode analysis, where we give a scoring based on the project performance over this kind of factors. So some of the key factors, let me just highlight for you here today. We always want to ensure there's a nice volume effect. Why we always recommend clients to go for bigger scale projects, for example, like 300 to 500 units and above, is because the volume effect is going to take place. We want projects that have consistent transactions. We don't want a project that has very little transactions. For example, like every 5 years, then you get one transaction. What's going to happen is that your bank valuations are always going to be on the lower end, just because the valuations are usually pegged to the latest transactions. So if that particular project doesn't have enough transactions, the chances of your valuation going up is going to be on the lower end as well. Quantum effect, parents attraction effect. So quantum effect really boils down more to the pricing strategy. So I think when we talk about pricing strategy as well, we always want to look at disparity effect. We want to see what are the prices in the surrounding area, what are the prices difference in the new launches, what are the prices difference in my next neighboring district. Is there something else I can buy better with this amount of quantum in today's season? So it boils down to a pricing strategy, parity effect, together with the time that you're buying in. Because let's say today I'm hunting for a house with a $3 million budget in today's context. Maybe I can get something still in the CCR region or the RCR region. However, maybe let's say we talk about 6 months later, the times might change. Maybe there will be a better opportunity elsewhere, right? So it doesn't mean that one kind of product will fit throughout the entire life, right? It really depends on when you're buying in as well. So the season also matters. Layout matters, whether there's any rarity effect in terms of maybe like there's an unblocked sea view, there's a really high floor sort of rarity effect, and maybe sometimes that project just have that kind of star effect, you know, where families go in, they love it because there's very good facilities. And MRT effect, rentability effect, more important one I want to touch on is also transformation plan. So we always want to toggle between the URA transformation plan. We want to see what kind of plans the government is placing in the area. So for example, we have really exciting townships that have been booming, like Condo. We have Condo Digital District. The entire area is still not fully done up yet. More to come. We have like Cross Island. We also have like the Bayshore plan. So all these are really exciting townships that have been happening. And in fact, if you take a look at the resale prices or even the new launches in all these areas, they have already taken quite a significant upward trend as well, because there is a good transformation coming into that. Right, so we also want to identify what kind of properties we are buying and what kind of category do they fall into. Are they like maybe high growth with high rental yield? That's of course usually the best. Or are they maybe low growth, low rental yield? We kind of want to avoid that. Or maybe they have really high growth but low rental yield. We can definitely still consider that, because capital appreciation is still going to outperform rental yield. So we really want to identify this kind of property, for example, as a 1-bedroom, 2-bedroom, 3-bedroom, certain region, whether it's landed, whether it's shop house, whether it's commercial, industrial. We want to understand which category, which quadrant do they fall into. And of course, when we talk about big properties, small properties, we always feel that small properties a little bit more like dividend stocks, like your 1-bedrooms. They give you good rental yield in terms of a capital growth. It may not perform as well as bigger properties, something like a landed or something like a 3 or 4-bedroom condo. So these are all the key frameworks that we use. And I think another question now that you might be asking yourself, you'll be like, hey, Caline, hey, Deborah, we are convinced, we want to move into the private sector. We want to upgrade our journey. But right, I don't want to compromise my family lifestyle. I don't want to give up where I'm staying. I love the East, for example, right? I'm an East Sider, East Side, West Side. I want that kind of location. I want to be near school. And I want my space. I want my nice 5-room HDB size. I don't want to go to a very small condo. Let me introduce you this concept as well. And I think this is something that you can think about. Property can be very exciting. It can be very fluid as well. Let me introduce you this concept called rentvesting. So this is a concept we are trying to have a balance, between property investing goes for meeting your family needs. So let me give you a real case study as well. So this is the Tay family. So this is what they have done with the rentvesting concept. So they used to own a 5-room HDB back in Sembawang. So they appreciated, they sold it, take out the equity, and they went on to buy 99 years landed back in the Sembawang area previously as well. It also then appreciated. Similarly, they saw the gains, they saw the growth, they sold it off, take out the trapped equity, and instead of going for one bigger landed, because their goal in mind for their family needs to have a bigger landed because they have multi-gen families staying together, and they need the schools, they need the location to be in the area that they have easy transport for their primary school going kids as well. So what they have done is they went on to buy 2 condos. So husband bought one, wife bought one bought in the OCR, one bought in the RCR. So right now, both, they rent that out. They're collecting about 10K rental combined from these 2 properties. So instead of going to buy another landed that's bigger and incurring a sort of like a higher commitment in terms of installment, they wanted to make sure that their family needs were very sort of settled. So they went to rent a large landed instead for their own stay. So currently they're renting that landed at $8,000. So in terms of a cash flow, you can see this is actually already a positive cash flow, because by renting that 2 property outs and going to rent one big landed, what it has fulfilled is, one, their own stay needs. They're getting the size that they want right now. They're also getting good cash flow, while at the same time, they don't really have to commit to a higher sort of quantum. For example, if they've gone on from like semi-D, it might be easily like $6-7 million in the area as well. And of course, with that kind of monthly installment, it's going to be easily 3x or 4x of what they are paying right now. So I think that was a pretty good strategy that this family has also deployed. They still continue to own properties. They are not out of the market. They continue to buy good projects that are still going to continue to grow while fulfilling their family needs. And of course, let's say, 5 years later, these 2 condos, they can always restructure again. Maybe at that point, they have a little bit more savings. Maybe then they want to reallocate their funds into a bigger lender, or they can continue doing this investing sort of strategy to fulfill their family needs. So I think we're going to leave this question to you guys. So what is actually your own dream retirement? So this is only an answer that you guys can answer for yourself, a question that you can answer for yourselves. And leaving you with another quote. So I think building assets, taking investments, risk only happens during your working years. So to recap, what Deborah was also sharing in some of our principles is that we do not want to waste your income producing years. If we are looking for property investments, we always want to make sure that we have active income in order to support that goal as well. Because once we are retired, the security of income for life should be your priority, right? So we also talk about the season of life stage you're in. Are we at the consolidation phase, or are we at the growth stage? We want to be more risk adverse at the end, because we just want to make sure we live stable, peaceful sort of retirement life as well. Then through all this kind of right planning, through the intentional planning as well as the right selection of properties, and through all the principles that we have shared also, we hope then you don't have to worry about what the markets will be doing in future or what life throws at you. You can then have that kind of peace of mind and really work towards your retirement goal. Right, so just a quick recap on the 4 principles that we have shared today as well. So Singapore private property, when correctly chosen, is a safe haven, especially because with the limited supply, so coming to understanding the demand and supply sort of situation here in Singapore when it comes down to our property. Principle number 2, loan capabilities during your income producing years should be maximized. So we always want to talk about our active income years and how we can use that to propel our entire retirement journey as well. Principle number 3, family Bs know which season of investing they are in. So coming back to that again. And principle number 4, property can be a great hedge against inflation, especially when correctly chosen. So I think that's all that we have for you in today's webinar. We hope that you have gotten some really good insights from today's sharing. We hope we have benefited you. And if you want to have a deeper chat with us, if you want to find out a little bit more about how you can better restructure your portfolio, feel free to contact our consults team. We'll be more than happy to connect with you. In the meantime, also sort of check out all our social media platforms if you want to know a little bit more about us. My name is Caline Leong once again, and together with me today was Deborah Guo, and we hope to see you once again.